Hey everyone, welcome back. Today, we're going to tackle something that's probably been giving some of you a headache. Figuring out the cost basis of your digital assets for tax purposes. Ugh, I know. Taxes. Not exactly the most thrilling thing to talk about, but trust me, this is important stuff, especially with those new 2025 regulations on the horizon. Before we get started, though, let me remind you that this program is brought to you by iFindTaxPro, where tax and legal compliance are made clear and the management of client communications simple. iFindTaxPro.com is a platform for professionals and their clients, open to everyone. And hey, if you have any burning questions about this very complex topic, we'd love to hear them. You can submit your questions to platform, and we'll do our best to address them in future episodes. So to help us untangle this web of regulations, we have our amazing expert back with us.
It's great to be back, and you're absolutely right. Understanding your digital asset basis is crucial for accurate tax reporting, especially as the IRS shifts to that stricter account-by-account approach in 2025.
Okay, so before we get into the really nitty-gritty specifics, can you give us a quick overview of why this is such a big deal? I mean, why is the IRS suddenly so focused on digital asset basis?
Well, it's not exactly sudden. The IRS has been gradually increasing its focus on digital assets for a number of years now, starting with those virtual currency FAQs back in 2019. Do you remember those?
Vaguely. Right.
Well, they provided some initial guidance on how to determine basis, but things got a lot more complex with the Infrastructure Investment and Jobs Act of 2021.
Ah, yes, the Infrastructure Act. That's the one that expanded the definition of a specified security to include digital assets, right?
Exactly. And that expansion triggered a whole cascade of new reporting requirements and regulations, including the need for brokers to report cost basis information to both the IRS and their customers starting in 2025.
So this account-by-account approach, it's all about bringing digital assets into the same tax reporting framework as traditional securities.
Precisely. The IRS wants to ensure that everyone is playing by the same rules, and that gains and losses from digital asset transactions are being reported accurately.
Makes sense. But I gotta admit, I'm a little nervous about keeping track of everything. I've been investing in crypto for a few years now, and my records aren't exactly pristine. Is there anything I can do to make this transition a little less painful?
Don't worry, you're not alone. A lot of taxpayers are in the same boat. That's where the IRS has actually provided a bit of a lifeline, a safe harbor outlined in Revenue Procedure 2024-28.
A safe harbor. That sounds promising. Tell me more.
It's essentially a way for taxpayers to allocate their unused basis to specific wallets or accounts as of January 4, 2025. This is particularly helpful for those who might have been using a more universal or multi-wallet approach for tracking basis in the past.
Okay, I think I'm starting to get the gist of it. But before we jump into all the details of this safe harbor, let's make sure we're all on the same page. Can we break down some of the key terms and definitions? I'm already feeling a little lost in the jargon.
Absolutely. Understanding the terminology is crucial for navigating these regulations. Let's start with the most basic term, digital asset. The IRS defines it as any digital representation of value that is recorded on a cryptographically secured distributed ledger or any similar technology.
Okay, so that covers things like Bitcoin, Ethereum, and all those other cryptocurrencies we hear about.
Exactly. But it's important to note that the definition also excludes certain things, like digital representations of U.S. currency or securities that are already subject to other reporting rules.
Got it. So what about basis? I've heard that term thrown around a lot, but I'm not entirely sure what it means in this context.
Basis is essentially your cost in acquiring the asset. It's the starting point for calculating how much profit or loss you've made when you sell or dispose of that asset.
So if I bought one Bitcoin for $10,000, my basis would be $10,000.
Precisely. And it gets a little more nuanced when you factor in things like transaction fees. But yeah, that's the basic idea.
Okay, that makes sense. Now, you keep mentioning unused basis.
Yeah.
What exactly does that mean? Is it like leftover basis from previous transactions?
That's a great question, and it gets to the heart of this safe harbor. Unused basis refers to the original cost basis of your digital assets minus any basis that you've already used in previous transactions.
Okay. Can you give me an example? I'm a bit of a visual learner.
Sure. Let's say you bought 2 Bitcoin back in 2022 for $20,000 each. So your total basis is $40,000. Then in 2023, you sold 1 Bitcoin for $30,000. You used $20,000 of your basis to calculate the gain on that sale. Now you have 1 Bitcoin left, and you also have $20,000 of unused basis.
Ah, I see. So even though I still technically have a Bitcoin that I bought for $20,000 for the purposes of this safe harbor, I actually have $40,000 of unused basis as of January 1, 2025, because I didn't specifically identify which Bitcoin I was selling in 2023.
Exactly. You got it.
Okay, that makes things a lot clearer. Now, I know we have a lot more to cover. But before we move on, can we clarify one more term that's been popping up? Unhosted wallet.
Of course. An unhosted wallet is essentially a digital wallet where you and only you control the private keys. It's like your own personal digital vault as opposed to a wallet held with a centralized exchange.
So think MetaMask or Ledgerite, those hardware wallets where you have to keep track of that super secret seed phrase.
Yeah, got it. Those are prime examples of unhosted wallets.
Okay. I think I'm starting to feel a bit more confident with the lingo. Now let's get into the nitty-gritty of this safe harbor. What exactly are the rules and how can I use it to my advantage? So this safe harbor, it's kind of like a one-time opportunity to get my digital asset records in order before the IRS comes knocking, right?
Yeah, that's a good way to think about it. It's a chance to align your basis tracking with that new account-by-account system and potentially avoid some headaches down the road.
Okay, I'm all ears. Walk me through how this safe harbor actually works.
It all starts with taking a snapshot of your digital asset holdings as of January 1st, 2025. Imagine hitting the pause button on your portfolio at that exact moment. You need to know exactly how many units of each digital asset you hold and where they are held, whether it's in an unhosted wallet or with a broker like Coinbase.
Okay, so inventory time. Got it. Then what?
The next step is to figure out how much unused basis you have for each type of digital asset. Remember our example earlier with the 2 Bitcoins?
Yeah.
You need to do that for all the different digital assets you hold.
Okay, so let's say I've got my inventory and I've got my unused basis all figured out. How do I actually allocate that basis to my wallets or accounts?
The safe harbor offers 2 methods for doing this,
Mhm.
specific unit allocation and global allocation. Let's start with specific unit allocation.
Specific unit allocation. Sounds pretty straightforward.
It is, in essence, you're directly assigning specific units of unused basis to specific units of digital assets in your wallets or accounts. Think of it like matching up puzzle pieces.
So if I have 10 Bitcoin in one wallet and 5 Ethereum in another, I need to allocate specific units of Bitcoin basis to those 10 Bitcoin and specific units of Ethereum basis to those 5 Ethereum.
Exactly. And you need to document these specific characteristics for each unit of unused basis you allocate. Things like the original cost basis and the acquisition date.
Okay, so meticulous record keeping is key here. I'm sensing a theme.
Absolutely. Detailed records are crucial for demonstrating that you've applied the safe harbor correctly. Now, the other method, global allocation, offers a more streamlined approach.
Tell me more about this global allocation. I like the sound of streamlined.
So with global allocation, you establish a predefined rule that determines how your units of unused basis are ordered and allocated to pools of remaining digital assets in your wallets or accounts.
Okay, so instead of matching up individual puzzle pieces, I'm creating a set of instructions for how to assemble the whole puzzle.
That's a great analogy. For example, your rule could be to allocate the units of unused basis with the earliest acquisition dates first, followed by those with later acquisition dates. Or you could prioritize allocating the units with the highest basis amounts first.
So it's all about setting clear and consistent rules beforehand. No changing my mind midway through.
Exactly. And just like with specific unit allocation, you need to document this method in your records before January 1st, 2025.
Okay, so both methods require careful planning and documentation. Got it. Now, what if I buy or receive more digital assets after January 1st, 2025? How does that fit into this whole allocation process?
That's a very important point. Any digital assets that are acquired or transferred on or after January 1st, 2025 are subject to the regular rules outlined in the final regulations, not this safe harbor. So you need to maintain separate accounting for those assets even if they're held in the same wallets or accounts as assets subject to the safe harbor.
So kind of like creating 2 separate buckets, one for assets under the safe harbor and one for assets acquired after January 1st, 2025.
Precisely. That way you can clearly distinguish between the two and apply the correct basis rules when you eventually sell or dispose of those assets.
Okay, that makes sense. Now let's talk deadlines. When do I need to have all of this figured out and documented?
For specific unit allocation, you have some flexibility. You need to complete it by either selling any of that type of digital asset on or after January 1st, 2025, or by the deadline for filing your tax return for the 2025 tax year.
So I can wait till the last minute if I want to.
Yeah.
But it's probably better to get it done sooner rather than later, right?
Exactly. Especially if you plan on selling any digital assets early in the year. Now, for global allocation, the deadline is a bit more rigid. You need to describe your chosen method in your records before January 1st, 2025, and complete the allocation by the same deadline as for specific unit allocation.
Okay, so no procrastinating on the global allocation. And what happens if I sell some digital assets before completing the global allocation process?
In that case, you'll need to use a standing order or instruction for identifying which specific units are being sold. Think of it as a default rule that applies until your global allocation is complete. This standing order can be communicated to your broker or recorded in your own records.
So I need to have a backup plan in place just in case.
Got it. Exactly. It's all about ensuring that you have a consistent and documented method for determining your basis, regardless of when you sell your assets. Now, before we move on, I want to emphasize that the safe harbor only addresses the allocation of unused basis, not its substantiation.
Okay.
You are still responsible for proving the original cost basis amounts through proper record keeping, as required by the Internal Revenue Code.
Okay, so the safe harbor helps me organize my basis, but it doesn't magically create records out of thin air if I've been a bit lax in the past.
That's right. You still need to have the underlying documentation to support your original cost basis claims.
All right, I think I'm starting to wrap my head around this safe harbor. But to really bring it to life, can we walk through a specific example?
Absolutely. Let's revisit our friend B from the revenue procedure. Remember, B had those 10 units of digital asset DE in XYZ wallet and 20 units in GHI wallet.
Yes, and B sold 6 units in 2024, specifically using the basis from the GHI wallet.
Right. So as of January 1, 2025, B has 24 units of digital asset DE remaining and 24 units of unused basis. Let's say B decides to use the specific unit allocation method and wants to sell 2 units from the XYZ wallet in March 2025.
Okay, so what are the steps B needs to take to apply the safe harbor correctly?
First, B needs to identify and document all the remaining digital asset units in each wallet along with the details of those units of unused basis. 10 units with a $1 basis from July 1, 2019, and 14 units with a $5 basis from September 1, 2020.
So far, so good. What's next?
Now comes the allocation part. B decides to allocate 2 of those $1 units and 2 of those $5 units to the 4 remaining units in the XYZ wallet. The remaining 8 units with a $1 basis and 12 units with a $5 basis are allocated to the GHI wallet.
Okay, so B is basically splitting the unused basis between the 2 wallets based on the number of remaining digital asset units in each wallet.
Exactly. And before selling those 2 units in March, B specifically identifies which units of unused basis are associated with them, 1 unit with a $1 basis and 1 unit with a $5 basis.
So B is meticulously documenting every step of the process, from the initial snapshot to the final sale. No room for error here.
Precisely. This detailed record keeping is what allows B to demonstrate a reasonable specific unit allocation under the safe harbor.
Okay, I'm seeing how this works in practice now. But what if, instead of selling those 2 units in March, B decides to be generous and gifts them to a family member? Does the safe harbor still apply?
That's a great question, and the answer is yes. The safe harbor applies to both sales and transfers, including gifts. The key is that the allocation must be completed before the transfer occurs.
So even if B is feeling charitable, those meticulous records are still essential.
Absolutely. Whether B sells or gifts those units, the IRS wants to see a clear and consistent method for determining the basis.
This is all starting to make sense. But I have a confession to make. My own digital asset records aren't nearly as organized as B's. I wasn't really thinking about taxes back when I first started buying crypto. What are the implications for me when applying this safe harbor?
I understand. A lot of taxpayers are in a similar situation. The key is to reconstruct your transaction history as best as possible and determine how much unused basis you actually have left to allocate as of January 1st, 2025. This might involve digging through old exchange statements, wallet transactions, or even emails to piece together your cost basis.
That sounds like a potentially daunting task.
It can be, especially if your records are scattered or incomplete. This is where working with a tax professional who understands digital asset transactions can be invaluable. They can help you gather the necessary documentation, reconstruct your transaction history, and ensure you're applying the safe harbor correctly.
Okay, so professional help might be a wise investment in this case. Now I have another question that's been bugging me. The revenue procedure mentions that this safe harbor is issued under Section 1012C1 of the Internal Revenue Code. What exactly is that section all about, and why is it relevant here?
That's a great question. Section 1012C1 is the foundation for the IRS's authority to issue regulations on how taxpayers should identify and allocate the cost basis of securities. The Infrastructure Act extended this authority to include digital assets, which is why we're seeing these new rules and this safe harbor being implemented.
So it's like the legal backbone for all of this basis allocation stuff.
Exactly. It gives the IRS the power to set the ground rules for how taxpayers determine which shares or units are being sold or transferred, and how to calculate the resulting gains or losses for tax purposes.
This all sounds pretty serious. Are there any penalties for not following these rules correctly?
Yes, there can be penalties for incorrect reporting. The IRS can assess penalties for underpayment of taxes due to negligence or disregard of the rules, and those penalties can add up quickly.
Ouch. Definitely an incentive to get my ducks in a row. Now, speaking of resources and guidance, I noticed that the show notes mention Notice 2025-7. How does that fit into all of this?
Notice 2025-7 is actually a proposed notice that builds upon the foundation laid by Reverend Proc 2024-28 and the final regulations. It's designed to provide even more specific guidance on certain aspects of digital asset basis reporting.
Ah, so it's like a sequel to Reverend Proc 2024-28, offering further clarifications and addressing any lingering questions.
Precisely. It delves into topics like hard forks and airdrops, situations where taxpayers receive digital assets as compensation or income, and the reporting requirements for brokers who facilitate digital asset transactions.
So while Reverend Proc 2024-28 provides the overarching framework for basis allocation, particularly for those pre-2025 transactions, Notice 2025-7 fills in some of the gaps and offers more granular guidance for specific scenarios.
That's a great way to summarize it. It shows that the IRS is working to provide taxpayers with the tools they need to comply with the law in this evolving landscape.
Okay, all of this focus on rules and regulations is starting to make my head spin. Is there any room for interpretation in this whole basis allocation process, or is it completely black and white?
That's a thought-provoking question. While the regulations and revenue procedures provide a clear framework, there are bound to be nuanced situations that require careful consideration and interpretation. Remember, the digital asset space is constantly evolving.
So it's not just about blindly following a set of rules, but also about understanding the underlying principles and applying them to new situations.
Exactly. And this is where seeking advice from experienced tax professionals becomes even more important. They can help you navigate those gray areas, analyze your specific circumstances, and arrive at a reasonable interpretation that aligns with the law.
This brings to mind a question from one of our listeners, Paul J. He asks, what happens if I can't reasonably determine the basis of some of my digital assets, even with the safe harbor? Maybe I lost some records or participated in some really early transactions with limited documentation. What advice would you give to Paul?
That's a common concern. If, despite your best efforts, you can't establish the basis of certain assets, you might need to consider using a reasonable estimate.
A reasonable estimate. Is that allowed?
Yes, in certain situations, the IRS allows taxpayers to use estimates when substantiating their tax liability. However, there are specific guidelines you need to follow to ensure your estimate is considered reasonable and acceptable. Again, this is an area where seeking guidance from a tax professional is highly recommended.
Okay, so it's not a free-for-all, but there are options available if you find yourself in that situation. Hopefully that provides some clarity for Paul J. Now, I have to ask, with all these rules focused on tracking and allocating basis, do you think it might discourage people from investing in digital assets?
That's an interesting question. While some might find these new regulations a bit daunting, I believe that clear rules and guidelines can actually foster greater confidence and encourage more mainstream adoption.
So you're saying that increased regulatory clarity, even if it seems complex at first, might actually be a positive thing for the long-term growth of the digital asset ecosystem.
That's my perspective. When investors know what to expect and how to comply with the tax laws, they are more likely to feel secure and comfortable participating in this space. It brings a level of legitimacy and reduces the fear of uncertainty.
Okay, I see your point. It's like building a solid foundation for future growth, even if it means some extra work up front.
Exactly. It's about creating a sustainable and transparent environment for everyone involved.
Well, we've covered a lot of ground in this deep dive. It's been a fascinating exploration of these new rules for allocating digital asset basis, and I feel much more prepared for 2025. But before we wrap up, are there any other crucial pieces of information or advice that our listeners should keep in mind? Well, we've covered a lot of ground in this deep dive. It's been a fascinating exploration of these new rules for allocating digital asset basis, and I feel much more prepared for 2025. But before we wrap up, are there any other crucial pieces of information or advice that our listeners should keep in mind?
Absolutely. We focus primarily on the safe harbor and its mechanics. But remember, the safe harbor only addresses one specific aspect of digital asset basis allocation, specifically how to handle your unused basis as of January 1st, 2025.
So what about all those other rules and regulations that we briefly touched upon? The final regulations, notice 2025-7, and even Section 1.1012-1 of the Internal Revenue Code. They all play a role in this complex puzzle, right?
Exactly. Let's start with the final regulations, TD 10,000, which were issued back in June 2024. These regulations lay the groundwork for the account-by-account reporting system that will take effect in 2025. They provide detailed rules for how brokers must report cost-basis information to both the IRS and their customers.
So if I have my digital assets held with a broker like Coinbase, I should expect to receive some new tax forms in 2026 outlining the basis of my assets.
That's right. Brokers will be required to provide you with a Form 1099-B, which will include information on the cost basis of your digital assets, the proceeds from any sales or dispositions, and whether those transactions resulted in a gain or loss.
Okay, so it's crucial to pay close attention to those 1099-Bs and ensure that the information aligns with your own records.
Yeah.
What about Notice 2025-7? We mentioned it earlier as a sort of sequel to the safe harbor.
Yeah.
Can you elaborate on why it's so important?
Notice 2025-7, while still in proposed form, provides crucial guidance on specific issues related to digital asset basis reporting. For example, it addresses how to handle hard forks and airdrops, which can create some tricky tax situations.
Ah, yes, hard forks and airdrops. Those events that can suddenly make your crypto holdings multiply sometimes without you even realizing it.
Exactly. Notice 2025-7 lays out the rules for determining the basis of these new assets. And when you might recognize taxable income, it also covers situations where you receive digital assets as compensation or income, which is becoming increasingly common.
So if I'm getting paid in Bitcoin or earning interest on my crypto holdings, Notice 2025-7 has the answers I need.
Precisely. It provides clarity on how to calculate your income and basis in those scenarios.
Okay, I'm starting to see how all of these pieces fit together. The safe harbor helps me address my pre-2025 basis allocation. The final regulations set the stage for the new account-by-account reporting system. And Notice 2025-7 provides additional guidance on specific scenarios. But what about Section 1.1012-1 of the Internal Revenue Code? You mentioned it earlier as the legal foundation for all of this. Can you remind me why it's so important?
Section 1.1012-1 essentially lays out the general principles for determining the basis of property, including securities. While it might not specifically mention digital assets, the IRS has made it clear that these principles apply equally to cryptocurrencies and other digital representations of value.
So it's like the granddaddy of all basis rules, setting the stage for everything else.
That's a good way to put it. It's the bedrock principle that underlies all these more specific regulations and guidance documents.
Okay, I think I'm finally starting to grasp the full scope of this digital asset basis allocation puzzle. It's definitely a lot to take in. Before we wrap up, can you offer any parting words of wisdom for our listeners who are feeling a bit overwhelmed by all of this?
Don't panic. Take a deep breath. And remember that resources are available to help you navigate these new rules. Start by reviewing the relevant IRS publications Reverend Proc, 2024-28, the final regulations, and FERS. Notice 2025-7. And if you have any doubts or questions, don't hesitate to reach out to a qualified tax professional.
Solid advice. It's always better to be proactive and seek guidance than to bury your head in the sand and hope the IRS won't notice.
Exactly. The IRS wants taxpayers to comply with the law, and they are providing resources and guidance to help you do so.
Well, on that note, I think we've reached the end of our deep dive into the world of digital asset basis allocation. It's been an enlightening, if somewhat intense journey.
It's certainly a complex topic, but understanding these rules is crucial for anyone involved in the digital asset space.
Absolutely. Thanks for joining me on this adventure. I hope our listeners feel a little more informed and prepared for what's coming in 2025.
It was my pleasure. And to all our listeners, stay curious, stay informed, and stay ahead of the curve in this exciting and ever-evolving world of digital assets.
And remember, if you have any questions or topics you'd like us to explore in future episodes, be sure to submit them to Platform. Until next time.